Okay, so welcome back. We're now going to move on to our next exogenous driver, and it is in fact our final exogenous driver and our final entire driver in our overall systematic process in the endogenous and exogenous driver analysis. So we're now moving on to the final one, stock market returns and relative wealth. So we've now covered 10 drivers across endogenous and exogenous analysis. And our final one, stock market returns and relative wealth, is one of these underestimated drivers in that not many people on the retail side, but definitely always every day on the professional side, pay attention to it. It's really about relative wealth across the globe. So the citizens of a country, if they're getting relatively wealthier or poorer to the rest of the world. Now you might have heard in macroeconomics and when you're studying in Forex a phrase called purchasing power parity theory, and this really applies here as well. So in your own time you can go online and learn about purchasing power parity theory. You may also want to look at the Economist's Big Mac Index, which also explains it quite well. But what we don't want you to do is definitely go and rely on stuff like the Big Mac Index, which comes out once a year and is pretty useless because of that. It's a sample that's taken annually and basically tells you relatively whether currencies are underpriced or overpriced due to the pricing of Big Macs from McDonald's in each country. So although in theory the Big Mac Index does give you a gauge on the overall relative cheapness or expensiveness of a Big Mac in each country and whether the currency is undervalued or overvalued relative globally, it's pretty useless when it comes to trading, because what traders need to see is up-to-date purchasing power parity indicators like the one we're going to look at now, which is stock market returns and relative wealth, because the stock market trades every day Monday to Friday and currencies are trading 6 days a week, and every day or every minute of every day people or citizens of countries are becoming, relative to each other, relatively wealthier or poorer. And that's because in the stock market, in most countries, the stock market is a proxy for wealth, because a very high percentage of people's wealth is in their pensions and inside the stock market, or long only the stock market. So in this analysis, viewers of the PTM video series will be quite aware of currency adjusted indices and looking at relative wealth, or looking at indices denominated in different currencies. If you've never done this before, it's actually pretty straightforward and quite logical. So let's go over to the computer screen and I'll see you at the end of the video for a recap. Okay, so welcome back to the computer screen. What we're going to look at now is the Australian stock market priced in US dollar terms. So what we'll be looking at when we do that is we're going to be looking at the stock market returns of the Australian Securities Exchange, the ASE, priced in US dollars. So by doing that, we're looking at it from a rest of world perspective. And the reason why we're doing this is because a country or economic zone's currency and their stock market are continuously and intermittently linked. They're linked continuously on a daily basis. So for example, if a country's currency goes down by 50% against all other currencies in the world, but their stock market stays at the same level as before, then their stock market has just become priced 50% lower to the rest of the world versus the previous period. So why do we even look at stock markets in the first place? Why are stock markets important to our analysis? Well, we look at stock markets because this is the main home for the pensions of a resident of a country through index funds, mutual funds, and personal investments. So the stock market is basically the barometer of wealth or pension wealth in a particular country. So if we take this example of the country's currency going down by 50%, if a stock trades in a local currency and the currency falls by 50% relative to the rest of the world, then that stock becomes 50% lower priced than the previous period. And this means the residents of a country in this circumstance have seen the value of their pensions wealth erode on an international basis by the same amount. Now, also, international investors may look when a currency falls to actually increase their holdings in overseas stocks as they fall overall in value. So this is why stock markets are important to our analysis, and stock markets and currencies, when we look at them together, is important to our analysis because they're inherently, continuously and intermittently linked. So what we do here is we go through a similar process as we've been through in the past with various other macroeconomic drivers, and the stock market value itself becomes one of our macroeconomic drivers. And we analyze this driver from the perspective of the rest of the world, or as the world's benchmark currency through the perspective of the US dollar. So what we do is, if we price the Australian stock market in US dollar terms, then we can see the Australian stock market on an international scale of wealth. And this is what it looks like. We'll go over to the exogenous driver analysis spreadsheet in a moment. But what you can see here is the value on the left-hand side of the Australian Securities Exchange top 200 stocks on this side here. And the value of the ASX is priced in US dollar terms, going back to 1995 up to present day. And on the right-hand side, you can see the Australian dollar, US dollar exchange rate. So you can see straight away that there's a very, very strong relationship between the pensions wealth or stock market value of Australia and the currency exchange rate, Aussie dollar, US dollar. So we can look at this a little bit closer if we go over to the exogenous driver analysis spreadsheet. And the tab that you're looking to go into is the stock returns file inside the exogenous spreadsheet. And you can see here on the left hand side we have our date, and this is actually now a daily data set. So the dates are going backwards by day. We have daily data of the Aussie dollar, US dollar exchange rate. We have the ASX 200 priced in Australian dollars. And then we convert this number here, the ASX 200 priced in Australian dollars, into US dollars by multiplying across the exchange rate. Now make sure you get this calculation right when you're doing this with other stock exchanges and currency pairs. The Aussie dollar, US dollar, the Aussie dollar is the base currency here. So one Aussie dollar buys 0.7604 US dollars. So when you take the local stock exchange, you have to multiply.
if we were doing a currency pair where the stock market in question, the domestic currency was the quote currency, we would have to divide. So make sure you get that calculation right. It should be pretty straightforward and obvious when you're looking at different currencies across different exchanges, but just make sure you get that correct in the future. For people that aren't aware of how you get this data, we'll show you how to do that now. If you just go into Yahoo Finance, you'll be able to navigate through the symbol field area, through the lookup area, and you'll be able to find the S&P ASX 200 by typing in this code. If you want to get different codes, you can do a search up here for different stock exchanges. But when you bring up the actual stock market, what you want to navigate to is the historical prices area. And you'll be able to get hold of daily, weekly, monthly data, and including or excluding dividends data. So we look for daily data, and what we take is the adjusted close. So the adjusted close price on the right hand side. And then all you have to do is scroll down to the bottom and you hit download to spreadsheet, and this opens up in your spreadsheet and that's the column you want. You want to take the adjusted close. So if we go back to the exogenous spreadsheet, again, we got our Aussie dollar, US dollar daily data from investing.com/currencies that Chris pointed out to you much earlier on in the video series. And this data, obviously, you want to get the daily data. So make sure all of your dates are lined up correctly before you start building your charts and doing your analysis. So you can see we've included the source links here. This EOD data you can get is another way of getting daily data for Aussie dollar, US dollar, or other Forex pairs. And we've got the Yahoo Finance link here. You can also navigate over to the sources tab to get hold of everything as well. So if we just go back over to stock returns, you'll notice the data set as well is going all the way back to 1995, so July 95. And we can start to navigate here on the charts. So if we click on the green line, you can see the green line is referencing column D, which is the ASX priced in US dollars, so priced against the international benchmark currency. So if we're pricing this in terms of the international benchmark currency, it means what we're looking at is Australia's relative wealth to the rest of the world. So we can see that Australian wealth has been going up fairly considerably from 1995 to 2010, and since then it's been trending sideways, so been moving within this range here. But we can also see that the Australian dollar has had a deflationary period against the US dollar here, an inflationary period against the US dollar here, and a deflationary period against the US dollar here. And how we analyze this? Well, if Australian wealth has been trending sideways since 2010, part of the reason for it not falling is arguably that the Aussie dollar, US dollar has been going down, and this has been holding up the wealth of the nation in their pension value. And how's it been doing this? Well, obviously, when we used that example earlier, where if a currency falls but the stock market doesn't, the stock market just becomes relatively cheaper than before. It becomes relatively lower priced than before. And we use the term cheaper loosely because in trading, investing, cheap and expensive is simply subjective. So viewers of the PTM video series will understand this very well, because we're obviously looking at stock markets here, but that's the basics of the analysis. We've had deflationary, inflationary, deflationary period, and Australian wealth overall up, but since 2010 going sideways on an international basis. If we look across to the right hand side, we can see here, zooming in from 2010 onwards, we can see that really the Australian market priced in Aussie dollars has been, sorry, priced in US dollars, has been going sideways and is kind of around a mean rate of 4,500 to 4,700 on the international benchmark US dollar scale. So if we go back over to the presentation, that's an analysis that you can do for pretty much every stock market in the world. And you should have a look at stock markets as your final driver, because this really gives you perspective on the wealth of the nation. And how do you actually analyze this properly? Well, if the ASX priced in US dollars falls, that's obviously deflationary for Australia, because it means Australian pensions are becoming worth less relative to the rest of the world. So in these examples, we're looking in these time periods to sell Aussie dollar and buy US dollars to protect against deflation in ASX assets. So imagine if you are an Australian yourself and you have a very high amount of your wealth, for example, tied up in the Australian stock market, in Australian stocks, and or you have a lot of your wealth tied up in your home or your business. If the stock market begins to go down, or the housing market begins to go down, or your business starts to see sales and profit going lower on an international scale, then it's pretty obvious that the way you hedge yourself is to sell the Aussie dollar, US dollar. So in these circumstances, it's no different for the stock market than to anything else. But we get this data daily. So we get told daily what is happening to Australian wealth on an international scale. So it's a fantastic analysis and driver for us. So when we see deflation in Australian stock market priced in US dollars, we need to be looking to short or have a short bias in the Aussie dollar, US dollar exchange rate. And we also seek to do the opposite when we have the opposite situation. So if the ASX priced in US dollars rises, this is inflationary for Australia, because it means Australian pensions are becoming worth more relative to the rest of the world. So here we must look to have a long bias towards the Aussie dollar, US dollar exchange rate in order to protect ourselves against inflation. So you'll often hear examples in economics of if a stock market doubles in value, and it does this fairly quickly, this kind of seeps over into consumer sentiment, and it does it really on a real-time basis. You know, if you're a consumer and you pick up the newspaper every day, and on the front or second page of a newspaper, you see headlines all the time, every day, of stock market going up, reaching new highs, your wealth going up every day, you're more likely to have high bullish consumer sentiment and more confidence in the future, and you'll be consuming more now. And that's exactly how it works. Stock market inflation breeds inflation in the prices of goods and services as the next move. And it can also drag house values up. It can also increase loans from banks in the debt market. So all of these things have a knock-on effect. They do feed off each other. So we use this as a very important driver. If we see ASX priced in US dollars rising and we see a lot of confidence in the Aussie dollar, US dollar, then we have to buy it, or have to have a long bias towards it to protect against the future inflation in ASX assets and in consumer inflation as well, and even business inflation. So it's a very important driver overall to our analysis. So how do we actually go about scorecarding for this driver? Well, it's pretty straightforward, but we just have to explain it in a bit of detail so there's proper understanding. It's fairly straightforward and logical. For the scorecards, what we're doing is using a high watermark of the ASX index priced in US dollars. What do we mean by high watermark? Well, we're looking at the high taken on it on the particular day where it reached that high and analyzing what it's done since. So the high was achieved, the high watermark was achieved on the 14th of December 2009 with a value of 6,208.48. So if you go through the data, you can actually go and find the day that the ASX priced in US dollars actually topped out. And then you can work out where it is now and how much it's fallen. And we take this approach because what we're doing is assessing relative wealth. So if the index in international US dollar terms falls by a large amount, this is deflationary because people in Australia are actually becoming poorer on an international scale. And they don't get richer nominally until the index has gone back through the previous high. So they don't get richer versus the rest of the world until it's gone through the previous high. And our scorecards basically score on a performance table, and we take the high watermark as the zero bound. And what we're saying is basically as the index falls in percentage terms, we have a deflationary scale, but if it falls too much, our conviction lowers because it means authorities are likely to step in. So if the ASX in this example, priced in US dollars, falls too far from its highs, we've got to be prepared as traders to reduce our conviction score because it means authorities are more than likely to use extreme measures to prevent extreme deflation and try to cause or spur inflation. And the same occurs on the positive side of our scale. If the ASX priced in dollars rises too far above previous highs, we've got to be prepared to reduce our conviction score because it means authorities are more than likely to use extreme measures to prevent hyperinflation and get inflation under control by causing a slight slowdown or causing a little bit of deflation. So where is the ASX right now? The ASX is currently down 28.2% in US dollar terms from its highs, from the highs of 14th of December 09. And that is basically very deflationary on our scorecard scale. but gives us a lower conviction number. So it gives us a -2 on our scorecard. Now remember what we've got here in our exogenous analysis, because we're looking at an exchange rate now and the dynamic relativity principle. What we've got on our inflationary side of the scale, because we're looking at this from the perspective of Australia, so what to do with the Aussie dollar, US dollar, our inflationary side of the scale provides us with a long bias, and our deflationary side of the scale provides us with a short bias. So long bias on the inflationary side for Aussie dollar, US dollar, buy Aussie dollar, sell US dollar. On the deflationary side, we have a short currency bias, so sell Aussie dollar, buy US dollar. However, our case right now is that because in US dollar terms, the Australian stock market has fallen 28% since the high watermark of 14th of December 2009 at 6208, currently trading at 4456.55. Because of that fall, we have a lower conviction on our short, because we're very highly confident that there's probably going to be at some point some sort of managed intervention from central authorities, and we have to be prepared to jump to our zero bound or our inflationary scale, because the high watermark after intervention could start to approach. So we need to be quite careful that we don't get caught in these circumstances shorting Aussie dollar, US dollar at levels where the stock market domestically has fallen by a large amount from the high watermark, because it just means at these levels there's a lot of potential for central authorities to step into the market, manage public assets, and manage the Aussie dollar, US dollar to a level that means international investors will start looking at Aussie dollar assets as on a relative basis as an asset that's underpriced on an international scale. And international money might start flowing into Australia to pick up lower priced assets. So we have to be prepared that our conviction on a short bias with Aussie dollar, US dollar at these levels is lower than if the high watermark was going lower. We have deflation going lower, and we've lost 10-12% because it takes time for central authorities to react, and it takes time for monetary levers to actually work. So we have to be vigilant in our scoring, and we have to be vigilant in our position sizing when it comes to conviction on our trades. So let's go over to the trading desk again, and we'll do a recap and a rundown of stock market returns and relative wealth, and also a recap on the exogenous process.
Okay, so welcome back to the desk. Let's wrap up our final driver in our exogenous analysis and our final driver in our overall endo and exo systematic analysis, stock market returns and relative wealth. So what did we take from that? Well, I guess the main thing we need to take from it is a basis and understanding first that stock markets are actually an indicator of the wealth of a country. And when you adjust these for currencies across the world, what you're looking at is relative wealth from one country to another. And we learned very quickly that, if we price the Australian stock market, for example, or any other stock market in US dollars, so pricing it in US dollar terms, what we're doing is pricing it at the benchmark currency or the reserve currency of the world. So when we're doing that, if we get big drops in the stock market that's priced in the reserve currency, so in this case the ASX, if we get big drops in the ASX in dollar denominated terms, it basically means that Australians or citizens of Australia are becoming relatively poorer on an international scale. And Australians themselves can actually go in and protect themselves from this fall in their wealth by shorting the Aussie dollar, US dollar, because that's where their exposure is. Now, on the flip side, if we actually get a rise in US denominated ASX, what is actually happening is that we're getting inflation and Australians are becoming relatively wealthier to the rest of the world. So when compared to the rest of the world, because we're pricing it in the world reserve currency or benchmark, and because this is inflationary, the rest of the world who are getting poorer compared to Australia can actually come and hedge themselves by buying Aussie dollar, US dollar, and protecting themselves against the inflation in Australia and the deflation outside, or potential deflation outside Australia on a relative basis. So you could have high levels of inflation in Australia as indicated by dollar denominated ASX, but you could have even lower inflation, maybe not deflation, but lower inflation in the rest of the world. So we have this interesting dynamic where the Aussie dollar, US dollar ebbs and flows dependent on the relative wealth of the Australian stock market priced in US dollars, so compared to the rest of the world. So understanding that principle is really key. So it's a relative wealth dynamic, again, applying the dynamic relativity principle because we're using it as a relative measure and as a driver to scorecard our bias in the Aussie dollar, US dollar exchange rate. And again, you can't sell Aussie dollar and not buy something on the other side. So if we're selling the Aussie dollar, US dollar exchange rate, we're buying US dollars. If we're buying Aussie dollars, we're selling US dollars when we're trading the Aussie dollar, US dollar exchange rate. So the dynamic relativity principle again applies here. So with our scorecards, we actually got from the drop of 28% from the high watermark, we got a score of -2, which is again deflationary for Australia. So it gives us a minor short currency bias because our conviction falls when we get huge divergences away from the high watermark, because we know central authorities are more than likely to do extreme things and step in. And that means as well that as a minus number in our last driver within the exogenous analysis, that means we've got 4 negative numbers for Australia with data taken from February and March. So now we're actually going to go straight over to the computer screen in the next video, and we're going to wrap up the whole analysis. So we're going to merge the exogenous analysis and the endogenous analysis and show you how the overall process works, so you can then take each driver, take the whole systematic process and apply it to any country in the world on an endogenous basis and any exchange rate on an exogenous basis, comparing 2 countries or currencies relative to each other. So let's go straight back over to the computer screen in the next video, and I'll see you on the other side for a recap of the whole endogenous and exogenous analysis.